Welcome to SmithWeekly Discussions, an occasional program for our members of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine our show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion today, we want to say thanks for questions coming from our audience of Smith Weekly, including Ann Hill O, Paul M, Ken S, Jared W, and Brent S. Joining us on the program today is Mr. Bram Vanderelst. Bram is the head of uranium at Curzon Resources, a commodity trading group that deals in various materials, including uranium. The company has involvement in the uranium market via offtake agreements and through its trading expertise. Curzon Resources is based in London, United Kingdom. You can learn more about Curzon via their website, curzonresources.co.uk. Bram, good to have you on the program. How are you?
Hi, Andrew. Yeah, good to be back. Very good, very good. How are you?
Yeah, doing good. Everything's not too bad, and continuing to be quite an interesting year here. And I think some folks are quite frustrated with the market conditions, but pretty conducive to continue to see this thing just chug along and chop. And I think that's quite constructive, to be honest, over the mid to long term here. Bram, just for the audience, so you and I've been chatting for a number of years now, and Bram's a good friend, and he is also a very good and key contact within the network in the uranium sector. Of course, this is the first time on our public version of discussions, but you've been on a private podcast in the past with us. But let's start off with maybe just getting a background from you, Bram, past experience, and really why you found interest in trading and this funny uranium market.
Yeah, absolutely. I think as most people in our industry, you sort of roll into it at some point by accident, which was the case for me when I got approached by Torchu back in 2012 or 2013 to go work with them on their nuclear fuel team in London. Sort of that was my first interaction into the uranium market. Saw it as a challenge and took it on, and so working for Itochu. And then back in 2016, I started chatting with who's now my business partner in Curzon, a guy called Nicholas Clark. He's a very successful mining and energy entrepreneur. And so we set up Curzon Uranium together. And just to clarify, Curzon Uranium is Cyprus based. So Curzon Resources, which is our sister company, is London based, but Curzon Uranium, which is the uranium part of the group, is based out of Cyprus. And so we set up that company back in 2016. We then started signing some offtake contracts in the space, looking at the need for diversification of supply. We sort of predicted to a certain extent what was going to happen with uranium supply, and we saw the consolidation in the space, and thought that at some point in the future there would be need for new sources of material, which we obviously couldn't predict any of the events that happened afterwards with the Ukrainian war and the COVID situation and whatnot. But it sort of played out in a way like we predicted. And so that's how we dipped our toe in the uranium market. And then on the back of that, we started essentially leveraging my contacts in the space and started a uranium trading business. And this was back in 2016, 2017. We had a really slow start to our entrance in the industry as a new entrant. It always takes a lot of time and it's a big effort, but also we weren't really helped by the market, which was sort of trading around the $20 to $21 price range for better part of the first year when we were in the market, which was very frustrating to say the least. But we stuck it through, and we're still around right now, and we actually had a really good few years, especially since sort of 2020. And we're definitely a household name right now in our industry. We're probably in that top 5 to top 10 traders of the commodity. We're very well known, very well respected in the space, and so we're proud to say that Curzon Uranium is a partner that a lot of people in our industry like to do business with and prefer dealing with.
Yeah, good guy to definitely consider here because your knowledge of the market is very good. And also, I think you guys are a very reputable group that can be workable and flexible with the needs of various companies out there. There's a lot of risk in this market that we all take, of course, but at the same time, I think you guys provide a pretty good service and a pretty good bridge to certain needs of the juniors out there that might actually get to the day where, cake is in the can, if you will. How about we kick it off here with your thoughts on the market right now, and then also what you expect to see, over the rest of the year, Bram, or maybe trickle into 2024 a bit. What are you seeing out there, and what do you expect for this year?
I think where we are right now is a market that's tight. Tight, and illiquid is the word to describe where we are at this stage. We've been leading up to this time frame for quite a number of years right now. We again predicted this 2017, 2018, where we start seeing inventories being drawn down. We saw the uranium market tipping from an oversupply into an undersupply, and then obviously we saw that snowballing with spots coming into the market over the last couple of years, and investors really taking an interest and a position in uranium. If you then look at the global macro picture, obviously nuclear has, at least in my lifetime, never had a better outlook. It's looking like nuclear will be one of the key sources of baseload energy going forward, it being obviously non-CO2 emitting. And so that obviously then has its effect on the underlying uranium market, which feeds off the nuclear power industry. And so if you then go back into the uranium market, what we are looking at right now is a market where inventories have been drawn down quite considerably. We're still in an undersupplied market by quite a long way. We've seen definite sources of secondary supply, mostly from underfeeding and re-enrichment. We've seen those dry up, or at least tipping into an overfeeding situation, meaning that actually there's secondary demand rather than secondary supply. And we see the market being very, very exposed to new mines coming online. We've obviously had an underinvestment in mines for 10 years past Fukushima. That is a situation that doesn't go away straight away, even though that we see more interest and more investment and more investor interest in the space. But it doesn't mean that you can start a mine from scratch in 12 or 24 months. And so what we're really seeing right now is utilities coming to the market again, trying to extend their coverage ratios, trying to extend their coverage further out from the sort of 2025 all the way to 2035, and some even beyond that to 2040. So there's a renewed interest in long-term contracting. There is a need for material. There's a need for restocking across the value chain, because we've really destocked to a large extent. Levels of UF6 inventory are very low across the value chain. Even levels of U8, which has always been the more available material, have destocked to a large extent. So we see a market that's really gone back to its basics, which is, well, what comes out of the ground needs to go into the value chain, into a reactor sooner, much sooner, and doesn't go cycle through a big inventory cycle. And that translates itself into what we trade most commonly, which is the spot market, where we really see bouts of liquidity and then bouts of illiquid periods, where we see the market being tied to uncommitted prime production coming into the market, or spot raising money and needing demand, and that really gets the ball rolling for a bit, and then the market sort of grinds to a halt again. And so if you look at the rest of the year, I think we look at a market that's ripe for potentially some disruption. I weigh my words carefully, because a lot of it depends also on the continued investor interest and the discretionary decision making by the utilities and how aggressively and how quickly they're going to do their coverage. But we see a market that's positive and a market that's ripe for ticking higher. Let's put it that way.
Bram, talk about just a little bit what you're seeing right now, let's say late 2022 and into 2023 here, in terms of the market transactions activity in the spot market specifically. I mean, we know that the term obviously is doing quite well here, and there's a lot of term activity going on compared to previous years, which is very good. But talk about, with respect to some of the trading, is there a lot of material out there at this point? Obviously we know that there's some spot market dumpers that come in, of course, and put material in here. But talk about that, and then let's also tie that in a little bit here with the fuel cycle and what we're seeing on the conversion enrichment prices, and just give the audience a little bit of flavor for what you're doing on a day-to-day basis, looking into this market and conducting some activity.
Yeah, it's very discretionary, I would say. So we go to real periods of dryness, where, like, going back to December, for example, it was probably one of the quietest Decembers I've ever experienced, where there wasn't really all that much transaction or all that much interaction. And actually, it started earlier. Like, we came out of the summer and into a lull in the equity markets, which had an impact on spot trading at a discount to NAV, and that sort of made the market look at, or maybe the players in the market look at the market slightly differently. Now you didn't have spot there as a buyer, so a lot of players sort of decided to take a step back and sort of reassess, which meant that the spot market wasn't all that active in Q4, at least not on a day-to-day basis. And then came around Q1, where spot all of a sudden started raising money again, and at the same time we saw some of that material that was uncommitted in Q4 last year that had been changing hands amongst the traders for a while, that ultimately always needs to find their way into a final destination, or somebody like Sprott or Yellowcake that sequesters the material for longer. What we really saw in Q1, when there was a lot of money raised from Sprott, and they actually came into quite a bit of material, and that was just an overhang from essentially 4 or 5 months where they hadn't raised any money, and uncommitted material that sort of built up a tiny bit, and that needed to flush into the market, which is also why we didn't really see a big price interact or price rally while Sprott was raising money. Right now, I would say the market is a bit more liquid than I've seen in the last few months. There's a bit more interest from your traditional traders and your traditional players to do something on that market, but it's still quite discretionary. We've also seen utilities pick up a bit of spot material here and there. That's also tied to their views on where the market is. And I would almost say, if you look at pricing, you see the market obviously cycle through to short-term booms and busts, or at least price peaks and troughs. You see the troughs being always slightly higher, and people readjusting their expectations. And so where 45 was maybe the bottom in Q4, you see that bottom closer to 50 right now, and that also then sets off a new interaction amongst natural buyers, like whether it be a primary producer or utilities, who are more keen on picking up material at higher levels because they've sort of changed their perception of where the market is. And typically, uranium's always been trading in sort of in ranges, so it's always been range bound, and we see the evolution of these ranges higher and higher. And then, yeah, as I said, like the spot market is sometimes really sitting on your hands and waiting for better times, and sometimes it's as busy as you can be, and you need all hands on deck. So it really goes to phases, and it's hard to predict it because some of it is dependent on when certain primary producers need to put their material through the market, either direct or via traders. Sometimes it's the boost of the underlying equity markets that pump Sprott or let it trade at a discount. These sort of main two things that are currently driving it in my view.
Right, and I'm definitely looking forward to seeing some more competition come into this market, and I'll come back to that here in a moment because we got something else to talk about on that front. Increased competition is coming, and that's going to put some good fireworks on the spot market here as we move on. And then I'm just excited to see the term contracting side, as you know, as some of the majors complete their books, how this is going to trickle right into the junior segment. Term contracting is going to be quite an exciting place to be monitoring, not only this year, but in the years ahead, and where utilities actually get material. And of course, there's going to be agreements for material that may never get supplied. We're moving into that next stage, if you will, that things are getting continued interesting here, in spite of what some investors would see at this point, or would probably say, I've been pretty beat up over the last year. Again, this sector requires patience. We've been here for a long time, and we get the attitude of the market quite well. But Bram, why don't we talk briefly about the spot market structure and get your view on this? Because I think, there's some people that have some different opinions out there on this issue. You've seen last cycle, the spot market structure itself in terms of liquidity and transparency is quite a bit different today, arguably better compared to 2007. Do you believe the market conditions can lead to notable price spikes, or do you think that the structure would really prevent that this time around? Of course, I'm very one-sided on this issue, but I think it's good because some participants question this. What's your view on the spot market structure today versus last cycle?
It's a difficult question, and I mean, there's a lot of questions in in what you just described, but let me try to unpack it a bit. Ultimately, can prices spike in this cycle as much as they did last cycle? Yes, they definitely can. Will there be certain fail-safe mechanisms that will prevent it from spiking as aggressively? Yes, also certainly. There's a lot more liquidity, there's a lot more experience now in this market. Don't forget, in 2007 or 2006, 2007, markets had been beaten up for years, and it was the market that was perceived as a commodity. There was much less interest, or there's much less traders around. There's much less activity, and it was much more sort of a long-term market. Right now, we've gone through a phase of 15 years where the trader's interest, whether it be independent or linked to a primary producer or utility for that matter, have really established themselves. There's more investor interest. There's more different products out there, or at least they've really matured. And so our markets also, through need more than by design, they needed to adapt to market conditions. And so our market has really changed into a market where it's almost become a financial market. So the carry trade has been very, very relevant all the way from 2011 onwards to, or even before that, but 2011 to 2020, where the main trade was like try to displace forward demand into current demand by doing a carry trade. Right now, and that's one of the reasons why I said inventory is destocking, we see the reverse. We see the reverse carry trade, where people with material on their books are willing to let go some of that material when there's temporary price spikes to buy it back at later stages from a producer or from somebody else who is willing to sell material in later years. And so that sort of comes back to your earlier comments about what's happening in the mining sector. And what we see is that, yes, the major primary producers, the big ones that have been around for a while, they have really had their fill on contract book, and they were the ones that utilities turned to the first when they started realizing actually this market might be heading higher quite sustainably. And therefore, let's go talk to these guys and let's go talk to salespeople and get a slice of that. They've become more picky in what they want to see in their contracts, whether it be market linked or higher fixed prices. And so they've signed less contracts, which means that as a fuel buyer, you then go to the next tier, which is, well, why don't I sort of look at the juniors and see if I can get some primary production from them. Or as a 30, you go to the traders or the carry traders and say, can I get some material from you on a carry trade basis, where you just lock it up and put it in a can for the next 5 years, and I'll buy it off you when I need it. But the carry trade has been hammered by higher interest rates and higher inflation rates, and so that's been a tough one. Even though that we see that playing out now in sort of the midterm, because there's really not, like, the midterm is really tight. 24, 25 is a very tight space, and we see the carry trade being supported there. On the longer term, 25 to 2030 and beyond, you see especially the junior contingent to tell utilities, yes, we can produce by that point as long as we've got the right support and the right contract book. And that means that we can fulfill your demand out there. And that's what I meant earlier when I said, well, we're moving back into a sort of a fundamental market where it needs to come out of the ground to be supplied into future demand. And that obviously comes at a bunch of risks. Any delay in production for whatever reason, and there's a hell of a lot of reasons why mines, whether it be brownfield or greenfield projects, wouldn't come into production. That means that some of those contracts won't be fulfilled, and that certain utilities or other off-takers will be left with material that they need to cover elsewhere, and they're going to need to jump into the spot market for that. And so I guess to answer your major question, can we see spikes in the market? Yes, because we are in a market right now where some of the buffers, which is levels of inventory that can be reverse carried, or alternative supplies through underfeeding, or any sort of other alternative supply, whether it be loans from Japanese utilities that don't need the material for a while, those kind of things are less easy to come by. They're less easy to get. And that means that you're exposing your market, or the spot market is already thinly traded and already quite illiquid, to big price jumps if there's enough money or if there's enough interest coming into the space. And it's anybody's guess how much money from outside investors can come into this space when it truly takes off. And what we've seen in the past is that it's always that the first 50 to 100 million is always hard, and then when the ball gets rolling, more and more interest, it gets more and more interest, and it's before you know, you raise a couple billion like Sprott did. So that could happen again, and because we're in a different situation than even now than when Sprott came in, and let alone comparing it to 2007, you could see that really jumping. And part, like the other structure of the market that's in a way, well, that's similar, but that also will allow for price spikes, is the fact that the people with material are probably going to want to see the market higher, and therefore are happy to just sit back and see the market go higher, and only start putting material or pushing material into the market as and when they see their incentive pricing. And that's not just primary miners, but there's certain people who have got long-term views or have been sitting on this market for a while, but there's really not all that much material left that can sustainably come into the market if there's really a lot of demand, and on top of that, a lot of investor demand flowing into our space.
Right, and it's all backstopped at the end of the day with term contracts. I mean, and this is all arguable amongst the C-suites in the sector with respect to where we sign contracts, the no risk nature for utilities in some cases on some of these contracts to just say, well, we'll sign a contract, and if these guys deliver, they deliver. But we've already taken the appropriate steps to make sure that this is backed up with other contracts in the case that some of these new juniors fail, which we know will. What's just interesting about it all is, you underpin any operations, whether it's new builds or restarts, by firm contracts. And then, of course, there's the question, Bram, of scale and so forth with some of these. But
if I can interject there for a second, what I would like, where you say, for example, that utilities are double covered because they've got some exposure to juniors, but they're covered with other contracts. We see a lot of utilities also using like expandable terms with producers or with existing producers. And so, for example, where you sign a long-term contract, or you have certain volume flexibility that you can flex up if you need to, and it would obviously invoke that if one of their junior contracts wouldn't deliver for whatever reason. But that doesn't mean that new material is created out of thin air. That's material that producer then needs to funnel into this contract that they might have overcommitted themselves, or they thought they would have it for some other for some other project, and that's no longer there because it's utilities calling that material right now, and that's something that they're going to do at the last moment. So it's not like there is just a pot of material sitting somewhere that we can dip into. Like we're going to have to produce that out of the ground, and we're seeing the right steps being taken. We're seeing juniors making the right strides to production. We're seeing expanded production from some of the major producers who are diligently putting into contracts. But it's a market that's very prone for disruption if anything goes wrong in that mining game.
absolutely, very big questions surrounding where this material actually comes from at the end of the day. We're going to be able to see quite a bit of this play out over the next few years for sure. Let's talk just on another topic. Get your perspective, Bram, with respect to how you guys look at your clientele. Of course, there's institutions, utilities, and uranium juniors out there that fall into your clientele area. But when you guys evaluate this, when you look at this market, I mean, Bram, even you and I looking at this market over the last, say, 5 years, it's changed so much with respect to personalities, with respect to some of the players, the progress of certain companies. But when you guys look out at the market and you're looking for a deal to get done that's beneficial for both parties, how do you evaluate these when you look at jurisdiction, when you look at the stage of the company, the people, which is so I can't underscore that much, the personalities of these people. Good grief, I mean, it's really a diversity in that respect. But how do you guys approach that, and what do you kind of look out for as key things that you guys want to see in a relationship, and maybe things that you don't find that appealing?
It all starts with having a believable project. A project, and we don't look at it from an equity perspective. So we don't look at a project with regards to the equity doing well or doing bad. We don't really care about it, aside from the fact that they will be able to finance or not. But we look at it, is the resource okay? That's where it starts from. Is it a decent project with good resource characteristics that might make it amenable to go into production at a somewhat decent price? As you highlighted, you've got all the other attributes to look at. You've got to look at the management team. Are they credible? What do they want? Do they want to push the stock price, or do they actually want to go into production? You have to look at the jurisdiction, and jurisdiction is a very difficult one because in a way, you want to be in a good jurisdiction. You want to be in Canada or Australia, which would have all the right mining codes and are very proper. But it also comes with a lot of risks, like the environmental permitting process takes ages, the mining permits take ages, and it's well described processes, but they just really take a lot of time, and a lot of things can upset those. In some of if you're talking about Africa, for example, which we do a lot of work in, like some of these things are easier, but there's also a lot of jurisdictional risk out there. Like it's not unseen in Africa that certain countries go through coups or that they go through a change of government, which might change the way they look at their commodity sectors completely, and therefore might derail a project to the extent that it's never going to get built. Same in the CIS countries. So jurisdiction is one that it's hard to classify formally, but it's something that we really look at a lot as well. And then it's really like, how can we work with them? And we've seen a massive shift in how people want to work with us and how they've worked with us in the past. We see, if I'd gone to a junior 5 years ago, it would be a very different discussion than with a junior today. Right now, they've been having discussions with utilities, a lot of them at least, and so slotting a trader into their off-take contract book is of less importance, even though I would argue that it's actually quite important because we would offer a lot of flexibilities that utilities can't. But that as a side note, whereas 5 years ago, not a single utility would touch any of the juniors and didn't think they would need to in the future. So juniors would be a lot more amenable to signing contracts with somebody like ourselves. So that's definitely a change. And then it's about the commerciality of the transaction. We offer flexibilities, but we also want to see certain things in our favor. And that's where you try to find a win-win situation where we can provide something that other actors in the space can't, and we get access to material that we might otherwise not have. And that's the way that we've been able to build a sustainable and quite diversified book on our end, which then ultimately helps us when we are marketing our material, because we need to market our material as well. We're not a final user of material. So that's sort of the role that we play in this space.
Very good points and insights on that, Bram, and such a difficult market to navigate. And then, as you said, just the personality changes and the differences we've seen over the last few years, quite substantial. And it's always difficult on that front too to gauge people and what their needs are and what their motivations are. And of course, quite a challenge to get through all that and then finally get to an agreement that everybody can sign on to and can finally move this down the road. And
we see a big variety of approaches in this space. We see people who clearly have zero interest in ever going into production, but really want to push their stock and their story. You've got people who are quietly really like chugging away at it and want to go into production, but don't like maybe lack some of the marketing. You see people who do, or like juniors who do it much better and who are really working with utilities, but then maybe sort of don't really consider the financing as much as they should, because finance is another thing that really takes a lot of time and effort, even if you have contracts. And then you've got other people who are really focused on financing and are happy to raise equity and finance and raise capital and finance, but they are maybe lacking on some of the operational aspects of things. Because a mine needs all of those. Building a mine, whether it be brownfield or greenfield, it needs all of those aspects, and a lot of it is chicken and egg, and that's what we see as well. A lot of juniors want to finance, but to finance you need contract book. But to get a contract book, you need to show that you can go into production, and you need financing. So that variety of approaches that is also reflected in the variety of management that we see out there and their characteristics.
absolutely. No, and we've even seen some try to start taking victory laps here, a little bit premature in my view. But so let's move on to a new physical uranium fund that is out there, the Zuri-Invest Uranium AMC fund. Talk about the fund in general and what it aims to do.
Yes, so we are linked to them in the sense that we will provide advice for them on the physical market. So Zuri-Invest is a Swiss asset manager who have been in the mining space for over 20 years. And they are launching, as you said, a physical uranium AMC, and AMC stands for Actively Managed Certificate. It's another way, or it's another instrument for investors to get exposure into the physical space, and where they differentiate themselves from the likes of Sprott or Yellowcake or some of the other lookalike investors or lookalike investor products is that they try to provide exposure for larger pools of capital directly into the underlying physical without trading on a secondary exchange. And so the way that you buy the MC is just you go to your broker, you put in an order, and the order will get filled at net asset value of the AMC. The net asset value of the AMC is simply calculated as the amount of pounds of uranium that it holds times the price of uranium plus the cash. And therefore, because it doesn't trade on secondary market and it always trades at net asset value, you're always getting the value of uranium. It's a key part of it because as an investor, what you want is you want a uranium exposure without needing to set up your own uranium trading team and try to really become a physical trader. But you want to take exposure to the price of the uranium, and so this is a vehicle that's perfectly suited for that. It's trading out of, or it's managed out of Switzerland through an orphan SPV structure, and it's really meant to give that exposure to the market in a frictionless way as much as possible. And essentially where we get involved as Curzon, we work with Zuri-Invest on providing the information on the physical market. We'll help them with finding the material in the physical market as and when they get orders in for the AMC. It will get right to a paying agent, but the orders will get routed to us to make sure that we can provide a coverage on the uranium market. And so we will go find them the material, buy it for the SPV, and then the SPV will hold and store it. So the investors know that it's secure as well. So it's in a way, it's similar to the existing players out there, but it's also very different, and it offers certain things that are better, certain things that are different, that we hope that would really sit well with investors.
And Bram, talk about a little bit more here on details for investors that are looking to use this type of vehicle. What are the requirements in terms of minimum funding, management fee, and also highlight the redemption, because this is also a bit different.
Minimum investment side is $100,000. So as I said, it's for larger institutions or for larger investors, and that's just a function of how it's operated in the background. As you said, it does offer a redemption feature, and that is important. Zuri-Invest needs to keep the price of the AMC trading at net asset value, and that means that you'd have to offer a redemption feature, otherwise you can quickly deviate from your net asset value. And so essentially, investors that want to pull out their money can always pull out their money, put a sell order into their broker. That order will then be fulfilled from cash if there's any cash available, and if there's no cash available, then the underlying uranium will get sold to free up the cash and redeem the investor. And that means that you're always, as I said before, you're always trading at that net asset value, and you're always getting the underlying physical pricing essentially for your AMC. Management fee is it's pretty competitive, so it's a 45 bips, and we're aiming at an all-in cost of around 1.2 to 1.5.
Appreciate that. And when you look at the participants out there, and I know we'll have growing institutional support and demand for this, but when you look at the existing players, the Yellow Cakes of the world, the Sprots of the world, in the last couple of years since these have been out, that Yellow Cake has been quite passive. And I'll even say passing on one of their options in one of the option years. Sprott has been fairly motivated out of the gate, but has also demonstrated a few other characteristics that I don't think people expected, whether it be surrounding the listing of the New York Stock Exchange listing that they attempted to go after, the depth test and testing of the market, which they did. But Yellow Cake and Sprott really haven't competed with one another, in my view. Not directly. Yeah, sure, there's some indirect consequences of this, but this is actually going to provide some more competition, because this is a group that is active in the market, and Yellow Cake isn't that active. They kind of rely upon their option, and that's more or less it. But I think this provides competition. So how do you see this? I mean, when looking at existing players, looking at this new fund that you guys will be providing your expertise with, how do you see this? Do you think this gets people motivated?
Yeah, absolutely. I mean, we've obviously done quite a lot of work in the background already, and Zuri-Invest definitely has. And well, first of all, we are looking at certain geographical diversification. So we are launching out of Switzerland, and we saw in our home market, we'll try to get as much funds in from there. But that doesn't mean that we can't compete in the markets that Yellow Cake and Sprott are active in, or if anything in Asia, because there's definitely a lack of this kind of exposure or vehicle that provides exposure in Asia. In a way, we are different, but we will be competition to these guys. And in a way that I keep going on about the net asset value, and this is something that you highlighted when you said Yellow Cake hasn't been active. And the reason they haven't been active is because it didn't manage to be active, because they couldn't raise money when their share price is trading at a discount to net asset value. And Sprott has the same issue. It's been less prevalent, but it's an issue that they face as well at times where for a couple of months, they can't raise any money because they're trading at a discount in asset value. And that's a function of them being exposed to the underlying or the overall equity markets. When the sentiment in the equity markets globally or commodities globally is negative, they see that reflected in their share price. And that means that they can't raise money and therefore can't really trade the uranium space. Whereas what the AMC offers and the way that Zuri-Invest set it up is that you're not exposed to the equity market. You essentially trade uranium. You buy and sell uranium at net asset value of the AMC. And if the AMC or if the uranium market is trading at 60, you're going to trade 60. The uranium market is trading at 40, you're going to trade 40. If it's trading at 100, you're going to trade at 100, regardless of where the overall equity markets are. And I think that's really where we see a lot of traction from bigger pools of capital, because they want to allocate money to uranium as a commodity. They want to allocate it to the space, and they have plenty of exposure in all of their other products to global equity markets, and they want to have that exposure reflected in their uranium pricing. And so that's really where we see a gap in the market. But obviously that also means that some of the funds that are currently deployed in some of these other vehicles can be moved into the Zuri-Invest vehicle or vice versa. And there will probably be a certain amount of interaction between the two or the three different funds as well. Money be moving between all three of them.
I'm just excited to see this finally get out there. I know we haven't been able to talk about it for quite a while, and I'm glad that this is finally hitting the market here, and I think it will do some pretty good things with respect to what it offers. What you said leads me to just ask you two other things. The structure of Yellow Cake is just not amenable to be able to override, if you will. And let's use an example. I mean, for a period of time, we always had $30 uranium. Some of these vehicles trade at a discount, but the underlying price of uranium is very attractive. And if you've done any work at that price point, is quite compelling to buy. And it's almost like, you know what, the price of uranium is so good here. Yes, we're trading at a discount, but let's override here, issue capital, and go after this. To me, that type of lever to pull can be quite beneficial. At least it would have been beneficial in the past. You know, as the price increases here, you're really doing yourself a disservice if you do get into discount mode. I think a piece of that discount, Bram, too, and looking at this over a number of years, is not only the sentiment piece of it, but then also investors discount the activity, maybe some of the management costs and fees. The junior example, Bram, for example, oh yeah, we've got this great asset, and we have X cash on the books, and we're trading at such a discount, we're even discounted to cash. Well, the reason for that is investors have discounted the fact that management's going to burn through that cash, and so it's obviously already discounted in. I know it's not apples to apples, but it's similar. But what's your thoughts on just the ability to be able to look, if the commodity price is right, yes, we're at a discount, but let's go get it anyway?
Every investor needs to have their own view on that. And I've had plenty of interactions with investors where they said, look, actually, I like the discount because it allows me to buy uranium at a discounted value, essentially, compared to the physical market. And that's true, but you're still exposed to that gap even widening. And you're essentially taking two exposures. You're taking your uranium pricing exposure, you're taking your gap exposure here. And that's something that Zuri-Invest didn't want to offer in their product, where they said, no, we want investors to have exposure to the underlying. So with a very simple example, if uranium prices go from 50 and you invest and they go to 60, you want to crystallize that $10 rise in uranium prices. But if uranium prices go from 50 and they go to 60, but you're at the same time, you're trading at a 10% discount, you've only crystallized $4 and you haven't had the benefit of that rise in pricing. It could be the other way around, and obviously this is something that works both sides. But as you pointed out very, very correctly, it's becoming more and more relevant as the uranium price is higher and higher. At $30, whether you're picking it up at the pricing equivalent of 27 or 33, it didn't really matter, because the underlying macro showed that uranium prices need to go higher and considerably higher. At $50 or $60 or let's say $70 or $80, it becomes more important. And you want to make sure that if you've got a positive outlook, that you're not going to get derailed by general market actions. That's really where this product is different, and I think where it could do very well. And we've also had interactions with a lot of funds who want to deploy capital and who are deploying too much capital to go into some of these other vehicles, unless when they're raising they're raising publicly, but on open market actions because the liquidity isn't there. And what this AMC is offering is physical uranium equivalent liquidity. Granted, it's not the best, but it provides more liquidity than some of the juniors or some of the equities who are providing right now, where even $1 million can move the market. So that's really where it's different.
Right. No, and there is, of course, that arbitrage opportunity with respect to, the discounted units versus, actually having physical material to be able to leverage as well. On the trading side, in the interim, as this market progresses, do you see that this particular fund may or may not trade material in the interim? What's your thoughts on the trading portion of it?
No, it won't trade at all. So there will be no discretion decision making on the trading side. The Zuri-Invest guys are only offering access to market, and so they will buy uranium as money comes into it and maximize the cash position as much as possible to put it into the spot market and buy spot market uranium. They will only ever sell material when investors want to pull their money out and when there's no liquidity in the fund to provide it, and therefore they need to create the liquidity to by selling uranium. Those are the only two actions they'll take, and there will be no discretionary trading because that muddies the water. And they've taken the view that they didn't want to muddy the water. They want to have a very clean and clear investor exposure to the underlying physical uranium without building additional exposures to trading or trading sentiment in there.
So on this one in particular, where's a place or maybe an email that investors who have that capability to, high net worth investors who want to look at this vehicle, is there a website or a particular email or a person they should contact?
Yes, so they can go to the Zuri-Invest website, which is zuri-invest.ch, and they'll find all the information under the products section out there. And there they can register their interest, and they will get contacted by the Zuri-Invest team to give them all the information needed. And then ultimately they can go to their broker and put an order in through their standard equities broker, because the product is trading with an ISIN number, and you can look up the product on Bloomberg, and you can put into your order through your standard broker.
Excellent. Well, let's leave it there. I know you got to get going, and same here as well. But for institutions, utilities, and uranium juniors out there who might be listening in, why should they contact you and Curzon for trading and offtake services?
All for different reasons. But for the juniors should contact us because we would provide something that others can't provide to them in terms of offtake. We can provide flexibility across years, across locations, across pricing structures, which might be a bit more rigid on the utility side. On utilities contacting us, we can provide a variety of sources, and essentially in our market, where your material is coming from is becoming more and more important, and so you want to be diversified. You don't want to be contracting with 3 people who all get their material out of Kazakhstan, for example. And so that's really where we can be a diversifier for utilities. And for institutional investors, well, I would say first point of contact should be the Zuri-Invest guys to see if they want to get some leverage through the MC. But also, we're always happy to talk through the markets with those investors and see if there's something to be done directly with Curzon as well.
Bram, best way for folks to reach out?
To me, that would be either on my direct email, which is bv@curzonresources.co.uk, or they can always try to call me as well. I'm sure they can get my contact details directly from yourself.
Bram, thanks for the time today again, and we'll plan on chatting soon. Appreciate it.
Great. Thank you very much, Andrew. Appreciate it.